think we're going to see a lot more of what we just saw, which is a lot more volatility. It's really easy to say I'm really bullish, I'm really bearish. I kind of see a two-sided market. I think in the next year will be from where we are today, 10 down and 10 up.
That was legendary investor Paul Tudor Jones warning that more volatility is coming. And unless you've been living under a rock, you know how crazy the last few months have been. So how should you manage your 401k retirement account during these rocky times? Well, our next guest says that more than a quarter of savers are making one crucial mistake. Let's bring in Jeanne Thompson for a fast 401k. She's Senior Vice President of Workplace Investing at Fidelity and joins us now from Boston. Welcome back, Jeanne. And I know what the one mistake is, but we've been talking about it so much that nobody else really does know, so you need to tell us now.
Sure. Yeah, happy to, Joe. Thank you. Yeah, so the biggest mistake that people are making is that many are overweighted in equities. As you said, 25% are holding more equity. Some are even holding 100%. And in a market like this, you want to make sure that you're well diversified.
Normally, I'd say that you don't know how weighted you should be in equities unless you know the person's age. I mean, what if
that's right?
If you're in your 20s or 30s, I don't know whether that's true that you can be overexposed, can you? Because over time, equities are the place to be, right?
They are, and you really need equity for that long-term growth in the market. And for someone who's age 25 or just starting out in their career, we really suggest about 90% equity, and that's based on your typical target date fund. But as you get older, as you get into your 30s, 40s, when you hit 45, you ratchet it down a little bit, and at that point, at 45, we recommend about 85% equity.
No.
As you get into your go ahead.
No, I was just going to say that I think 45 is like the new 35, or actually probably really closer to the new 30. Do we take that, guys? You're all.
I was going to say 25.
25, Guy.
45 to 25.
Your 50's the new for you. It's the
I hope
30.
so.
Yeah.
I can only hope.
Do we grade it on the curve, Jeanne? Or are we really doing chronological age here? Because that's troubling to me.
Yeah, well, you can grade it on the curve a little bit.
Good.
So, as you, as you get, through your 30s, early 40s, still around that 90% equity. As you get to 45, you can do it down, because 45 really is 45 when it comes to investing.
Oh, okay.
Jeanne's humoring us.
Yeah, she is.
She is.
She realized, oh boy, these guys are very insecure. You're right. So if it's not stocks, I don't know, bonds, 39% bonds. What kind of bonds? I don't want bonds. Corporates? Can I get some high yields or something? I mean, government, I don't want a 10-year 260 government or 285 or whatever it is.
Yeah, within most 401ks, though, it's mostly mutual funds. So you've got your bond mutual funds, and most really offer the intermediate bond fund. That's the most popular within the 401k plan, for sure.
So with what we've seen recently, what's your advice in markets like this for your 401k?
Yeah, so within the 401k, it's much better to put time in the market than trying to time the market. Most people who are chasing the market will never catch up. And, investing for retirement is a long-term strategic proposition. And so you really want to get a good allocation, have a plan, stick with it, and not have a knee-jerk reaction with this market volatility. We found in 08 and 09, go ahead.
Go ahead. Finish your thought.
I was going to say, we found in 08 and 09 that many people who, got out of equities completely, they didn't see the long-term growth, and they never made up for that lost time.
All right, Jeanne, we thank you for the advice today, and Fidelity is a place I might certainly take that advice. But Guy, what's your take?
Well, Jeanne, she's been on before. She does a great job. My take is this: if we make it to January, I say if because I don't take anything for granted. This show will be 12 years old. The show was created to we try to tell people what's going to happen tomorrow, a week from now, with varying degrees of success. That's what this show is based on. In terms of 401k, though, you can't get caught up in the day-to-day stuff. You shouldn't be, in my opinion, you shouldn't be looking at the gyrations of the market on every 30-minute basis. So stay the course. That's exactly right. Have intelligent conversations, but don't be crazy.
Sometimes you have to use it as a catalyst where you don't want to pull your money out, and you don't want to pull your money out of equities and dive into bonds because you don't know if you're on time or you're missing the time. But if you feel like you're getting bargains, you can increase that donation into equities instead of pulling it out and trying to time the market. You're never going to do that. I would add to equities on dips for the longer term, depending on your age.
The one thing I'd say about where we are right now, which has been very challenging for people for even 6 months now, is, let's face it, fixed income was not doing well. And we're in a period where we've had this secular bull market in bonds. We've had 5 decades straight where rates have been compressed. And we have this argument that central banks are no longer in play and that we have this upward momentum on rates. That is something that's had bond vigilantes being, I mean, it's an argument why fixed income has been a more difficult selection in a traditional sense because, frankly, it's worked.
All right, good. All right, thank you, Tim. Shatner, 88 years old. Just a thought. Anyway, if you think that...
Should he have bonds in there? What do you think?
Shatner should still be mostly stocks,
Equities.
mostly Priceline.